Hey, what's up guys, John here. Real estate is changing all across America. It doesn't matter if you're in Cleveland, where I am, Nashville, Atlanta, Philadelphia, it doesn't matter. So much apartment construction unfolded during 2020 and 2021. You have a 50-year high.
New apartment construction is soaring across parts of the United States.
And real estate experts say it is now on track to be, in fact, a 50-year high.
And what's now unfolding is high interest rates, high insurance, high taxes, and high stress for a lot of these investors. So much so that many of them are going out of business or they're reducing rents. I saw a video yesterday on X where a woman shared her story of receiving a letter that the landlord is reducing her rent voluntarily $200 per month.
Got my lease renewal offer for my apartment in Austin, Texas, and it went down almost $200.
Now, it might not sound like a lot, and some people might say, hey, look, John, this is a great thing, because cost of living is way too high. These landlords do need to, reduce rents. I want to kind of look at this clearly before coming to a conclusion. And as I'm doing that, I'm going to show you a property that I just acquired right around the corner. It's going to be the new headquarters for singlefamilyinvestors.com. Show you what's unfolding in Cleveland and show you how you can make money throughout this entire, pain period that's going to be unfolding throughout real estate. So, Cleveland's no different. I mean, look behind, see the brew house? This is what happened in every major city. The breweries, the new apartments, the arts districts, all this. Everyone had the money. Everyone was, living life, enjoying life. Now the affordability crisis is weighing heavily on consumers. So much so that many of them, can't afford car payments, credit card payments, can't afford to live, let alone going out for an $18 beer.
Skyrocketing housing costs have many families in America living in a nightmare.
So what is happening right now with this $200, look, I'm going to show you this. This is absolutely crazy. Look at how many vacant apartments, how many apartments under construction just on this one street. So all new, everything. There's thousands of apartments under construction or completed in the last 24 months within like a quarter-mile area of this. So if the landlord reduces rents, let's just call it $200 for her example, that's $2,400 in lost revenue for that one specific apartment. Now, if there's 100 apartments, that's $240,000 in lost revenue. Now, if you take that number and you divide it by, let's call it a 6 cap, meaning if you paid all cash for the building, you would get a 6% return. Well, $240,000 divided by 0.06 would mean that would be a 4 on 100 units, 240 grand. It would mean that the landlord would basically lose $4 million in value. If there's 200 units, it'd be $8 million in value. And you just continue, moving the math up. If it's a big apartment complex, like something here where they have 250, 300, 400 units, this could be a $15 million loss just on the rent reductions alone, let alone insurance going up, taxes going up, everything just getting more expensive for these developers to operate, and it's a big problem. It's a very, very, very big problem. So here's what I think is going to happen. Now you have $1 trillion in multifamily debt that's going to roll over, meaning it needs to be refinanced from now until 2027. 2 years is going to fly by. $1 trillion is a lot of money. When you have $1 trillion that needs to get rolled over and refinanced, and these investors bought these buildings thinking rents were going to keep going up 20% a year, and you have insurance and taxes going through the roof and borrowing costs going from 3%. Some are arguing that borrowing costs could go to 8% at the end of this year. We'll see if that actually happens. Right now it's pretty close to 7. So, Apollo just said that they believe that there's a good chance that we could see interest rates going up. And if you look at the last 2 Fed cuts, what happened? Interest rates went up. So they're saying that the Fed's actually going to pivot in general, not just, they're going to cut 25 basis points and rates are going to keep going up. No, they think they're going to continue to add, and we'll see if that actually happens. But that was what that's what they, projected. They said it wouldn't be impossible. They think this could very well happen. I think they gave the odds of like 40 or 50%. So let's say, for example, that you have this building, and this building is worth $20 million. At the peak, hypothetically, 20 million. Now they think it's worth 15 or 12 million, right? Well, the new investor would be able to go in there and acquire that building. They'd put maybe $3.5-4 million down. They'd buy this $12 million deal, and they would hypothetically be able to rent out their units for a lot less and still remain profitable. Like, look at this. Everybody was getting a piece of the real estate development business the last couple of years. This one just finished. I mean, this right here, this just finished there. This one is still under construction. It looks like a mom and pop, or maybe slightly bigger than a mom and pop. You can see kind of the scale of it, right? So you start to see how big this situation is. If someone's going to buy that $20 million building, even the ones that can afford to hold on to that building and refinance somehow, maybe they do a capital call and get investors to pitch up money, put more money in the deal, and they're able to save it. The person that's buying it for 12 could reduce rents. And it would be actually very intelligent for them to do that, because if they reduce rents, even for, let's just call it a year, 2 years, it will put a lot more pain on the other investors nearby, increasing the likelihood that they're going to fold, and increasing the likelihood that that one investor is going to be able to buy the other deal next door for a great discount. So that's what I think is going to happen. I think we're going to see this situation where there might be short-term, rent reductions in the short term, but as we start to see this concentration of wealth continue to move from one pocket to the other, because these corporations are going to be, I believe, at the end, going to be the beneficiaries of all these apartments. There's going to be a lot of these mom and pops, a lot of these smaller developers going completely under, and a lot of these big corporations going to acquire these buildings, and eventually they're going to continue to increase rents. But I think we're probably going to go through a period the next couple of years where rents are going to be softening on the new construction. Now, why would I invest in real estate right now, given what's happening and all this? Well, I think two major things are going to happen. First is the dollar, I think, is going to likely soften over the next couple of years, and owning hard real assets are going to be where I want to be personally. And second, I think that what we're likely going to see is a lot more pressure on luxury apartments, a lot more pressure on the high end, like all of this inventory. I mean, there's so many of these projects, it is crazy. Like, I'll show you this one right here. They're probably building 1,000 units just in this one pocket here, 1,000. So if you look at what was just developed over there, and then you look at the scale of this, what you'll see is that these builders are going to be in very big trouble. But where I'm investing, my approach, I think, is going to greatly benefit from all of this. Let's see if you can see that. So it's pretty hard to see because of the snow, but I'll pull over here a little bit more, you'll be able to see it. So they're probably building, I don't know, I would call it 1,000 units right here, somewhere in that range. Like, it looks like a substantial project. Yeah, so you can see it right here. I mean, this is only one side of the building. It's very deep, but all of these units, it goes way back. But these investors are going to be in big trouble. Where I'm investing is, so for example, in the height of the market, these properties, the townhomes and these luxury condos, they were selling for like, the luxury condos are selling for like $550, and the townhouses are selling for $800,000. Like $800,000 in most markets. Like, okay, $800,000 is kind of like not impressive in LA or any of these other areas. But in Cleveland, $800,000 is absolutely crazy. But where I'm investing, I'm able to buy these properties $50,000, $60,000, $70,000. So if I could be within a quarter mile of $800,000, $700,000 sales, I like that. Because what I think is going to happen is, I think this affordability crisis is going to push people outside of these luxury condos and these luxury units to affordability. And I think affordability is going to be the big winner here. So, and I'm going to show you this place that I just bought. Well, we're set to close on the 17th, so I haven't officially closed yet. We wanted a contract yesterday. We're going to be closing Friday, so the following Friday, next Friday. Which is going to be the headquarters for singlefamilyinvestors.com and also singlefamilymanagement.com. And also going to have a YouTube studio there, a podcast room. It's going to be really awesome. I don't want to make the address public, so all investors that are investing with us can swing by and pop by anytime. So what I think is going to happen is, if the housing market does crash and the economy does crash, I think it's going to be really bad on the luxury end, the high end. I think borrowing cost, it doesn't make sense to buy a home for $700,000 at a 7% interest rate for most people. And those people are going to have to reduce their demands if they want to buy a home. And if they want to rent something, a lot of people they're not going to be able to afford to drop $3,000, $3,500 to be next to the brew house. They're just not, right? Where are they going to go? They're going to go where they can live and feed themselves and have, heat on and go out and buy some shoes, like have a little bit of spending money, right? That's where they're going to want to go. And so when I'm buying these homes for $50,000, $60,000, that if I, let's say I have no debt on them, tax and insurance about $250 a month, make $1,200 on a $50,000, $60,000 house, I like those numbers. And what I think is going to happen is I think the spread from what those luxury units are renting for presently, which is about $3,000, I think there's going to be a softening in the short term, and then it's going to go back up. But I think those $3,000 units might stay at maybe $3,000, maybe go up a little bit in the long haul. But these affordable properties that are $1,200, $1,300, $1,400, $1,500, $1,600, these properties I think are going to go up higher and higher and higher, and there's more room for these areas to grow. And I think we're going to start to see a lot of rent growth in these affordable properties that are very close to the brew houses and everything else that is kind of happening in that area. So this is the building. I personally think it's the ugliest building on this street. Like, no doubt, the thing looks atrocious. But in about 2 weeks, this place is going to be stunning. See that ugly pole in the front? We're going to get rid of that. We're going to put new windows in, new siding. It's going to be like a blue with a light green door. It's going to be very, very, very bold. You get over 1,000 cars driving by every single hour next to a Popeyes, next to a Family Dollar. It's basically the demographic that we're going for, which is people that they're penny pinching, right? They're trying to get by. Well, they're going to be driving by all day long in front of my building. And we're going to be dropping a lot of money in ads in this entire area. We're going to start with about $25K a month, and then we're going to scale up in about 90 days. The plan would be to scale up to $50K a month, and then after that, $100K a month we're going to be spending. Just blanketing this area and a handful of other areas to where we can get the best deals. Like, I'm going to show you this house that just sold for $50,000 that I believe is beautiful. 50 grand. So you tell me what you would do if you're making $150,000, $200,000 a year, right? Which is a lot of money, right? Would you go drop $4 grand a month to have a luxury townhouse, or would you buy one of these homes for 50 and your mortgage, well, you wouldn't probably be able to get a mortgage less than 50, so you'd have to pay cash, but your tax and insurance be $300 a month, and of the 150 you'd be able to save most of it, right? You'd probably do that. Well, what about renting? If you're renting and you're making 150 a month or 150 a year, making 12 to 15K a month hypothetically, maybe you're making close to 200, right? 10K, 15K, whatever it may be, you would probably rent for 1,200 if you were smart. You'd rent for 1,200 or 1,500, 16, 1,700, then rent for $3 grand or $4 grand, right? And blow all your earnings on renting. Right? So you would start to see this big push one way or the other. I think everything is going to go towards affordability the next couple of years, because prices are only going to get more expensive with everything. Car insurance, like you name it, everything's just going to get more expensive. So people are going to have to start changing how they live and where they live to accommodate for those rising costs. So this property sold for $50,000. I'm going to get out and show you. 50 grand for this house. I think it's beautiful for 50. I think it's beautiful for 200. So look at this. It's 4 bedrooms. Right there. You have the garage in the background, right? 4 beds, 2 bath, 50,000. That's sold for. That's pretty incredible. Section 8 would probably pay maybe, I'd have to look on the 4 beds, but you might pay $1,600, somewhere in that range. Like, for a $50,000 house, crazy. And these areas, you don't see bars in the windows. Like, these areas are, they're decent. I wouldn't say they're like amazing, but they're kind of whatever. But for 50K, I think they're amazing. I think they're awesome, and I think they're very undervalued. Right up the street here, you'll see nothing but brand new apartments, brand new construction. So this is the bet. The bet is affordability is going to be one of the biggest problems. And if you invest your money correctly, you're going to be able to ride that trend, ride that wave. And I think we're going to see this being the big opportunity in 2025 and 2026 is going out there, acquiring the right deals in the right areas, and really striving for operational excellence in managing these properties. That's why we're building out the property management arm, and we're doing everything that we're doing so these properties are run right, managed right, and they're profitable where they should be. Look, all brand new. All brand new. Imagine being the developer trying to rent out those in 2026, 2020, late 2025. I wouldn't want to be. I'd want to be the one that owns hundreds of those affordable units. Look at all these. All brand new, right? All brand new. And the same one next door or right across the street. All brand new. You want to be the one owning all the $50,000 houses, because things hit the fan, job market falls apart. A $50,000 house, who cares, right? A $700,000 townhouse, that's painful, right? Because you know that $700,000 townhouse might go to 400. That's a really difficult pill to swallow. But if it goes, a $50,000 house goes to 20,000, 30,000, does it matter? Really, does it matter? No, it doesn't matter at all. If anything, it's a great thing, and it gives you a lot more opportunity to go out there and buy more and more and more homes. That's why right now I'm out here doing what I'm doing, because I think we're going to see a lot of opportunity the next couple of years, and I want to have market share out here. I want to be the biggest home buyer in Cleveland, and we're starting our advertising campaigns. We're doing everything we're doing to position ourselves for this moment. And so we're going to continue to grow and grow and grow. And as the world gets harder, we're going to get richer. Like that's what's going to happen. Like we're just going to continue to scale this situation up and capitalize on what I think is going to be the inevitable that's going to unfold inside of the U.S. housing market. You don't really have much of an alternative. You don't have much of an option. It's either we're going to build out a plan and a strategy, and we're going to execute diligently with the right team members and the right approach, with a very, very, very strong advertising campaign, or, a lot of people say, look, you shouldn't buy houses, you shouldn't buy the affordable houses, or you shouldn't do this, you shouldn't do that. Look, there's either talkers and there's doers, people that are actually going to go out there and do something. If you're somebody that, maybe you have a family to provide for, or you have a retirement to provide for, the next couple of years is going to be extremely important. The government's not going to come out and save anybody. Nobody's going to come out there and combat, the problems of the world. Everyone is going to go out there and do what's best for themselves and for their business, and they're going to strive to survive, right? They're going to strive to survive. And the ones that are actually working hard, that are really going for it, are going to be the ones that are going to be able to get through the hard times. Because what I think is going to happen is look at all this, it's all new. What I think is going to happen is I believe, a couple of years ago, if you made $100,000 a year, that was considered like a great income. I believe in the next 10 years, you're going to need to make $1 million a year minimum. Maybe if you're living in a big city, a lot more than that. But that's what I think is going to happen. So if you own tons of these affordable properties, like over here, they're renting all brand new apartments here, I'll show you. If you own tons of affordable housing units, and let's just call it, this does happen, if you own 10 of them, 20 of them, 30 of them, and you're able to get those residuals every single month, as inflation likely gets worse, the cost to replicate and rebuild these homes will continue to get more and more and more expensive. Your net worth is going to grow. Look at this, all brand new. It's all going to grow. So that's my advice. Plan for inflation, it's coming. Invest accordingly, and you want to invest in low risk deals. Very, very low risk deals. If you're going to take on debt, be careful with bridge loans. Be careful with any commercial loans. These residential 30-year fixed rate loans, it's the best loan product out there. So if you'd like to learn more about what we're doing or possibly invest with us, you can go to singlefamilyinvestors.com. That's singlefamilyinvestors.com. If you have $100,000 or more and you're just not sure what you want to do, learn what we're doing, and if it makes sense for you, love to help you. singlefamilyinvestors.com. Catch you next video.